Hello everyone and welcome back to the Velocity channel, where this is your bridge to financial freedom. Well, I had somebody contact me the other day and said, listen, CJ, what do you do when there's no debt? Well, I'm going to show you what to do when you no longer have any debt because of you utilizing the Velocity banking methods. I'm going to show you how Velocity banking can still help after debt, because there is life after debt. Folks, thank you so much for tuning in. This is going to be a shocker for many, but it's going to be a refresher for some, especially those that have the Money Max account. I want to show you how not only to get out of debt, but what you're going to do after debt, okay? Now, before we do that, let's go ahead and like, share, and subscribe so that everyone around the world can know the power of Velocity banking. Listen, you have a mortgage, right? You've got the car loan. Many of you have student loans, right? All types of loans, it doesn't matter. What I'm about to show you is going to go against some of the conventional wisdom that we've been taught growing up, but it's going to eliminate your debts very quickly. And on top of that, it's going to make sure that you grow your wealth just as quick. So let's go ahead and look at what we have here. Then we're going to dive right into it. We have a mortgage of $200,000 at 6%, $1,200 each and every month, all right? 30-year mortgage. No wonder the sad face is on the zero there, right? You're in it for 30 years. I don't know how old you are, but that is unacceptable. Let's go down to the car loan. $30,000 at 7.4%. We got into 5 years, if that's the term, $600 each and every month, all right? Now, we also have a line of credit. Limit is $15,000. The balance is $12,000 at the 21%. That's $600 each and every month. If you were to pay just the $600 each and every month, you'd get out of that credit card or line of credit in about 4 years, possibly more. All right? Now, what they've told us is that it's wise to segregate our income. Okay? How did they tell us that? Well, let's just say the national average is $5,000 each and every month that people get paid. Well, they say, hey, go ahead, get that mortgage. That's $1,200 each month. Let's go ahead and get that car. That's $600 each month. The credit card, $600 each month. Oh, by the way, groceries or whatever else, $1,200 each month. And by the way, the savings account, $1,400 each and every month. Now, do you really want to save when you have zero in cash flow? Remember, when you're in the employee mindset, what's your mind on? How much does it cost, right? How much will I make? You're only focused on the income versus what the wealthy focus on, and that is cash flow management. What can I do with the money that is coming in that I may grow this money? Okay, that's what we need to be on, all right? Now, you were taught as well, let's go ahead and put it inside of a checking account. Let's go ahead and segregate our income so that we have $0 left at the end of the day. I want to share with you something. What if we were able to pay off all of these debts in record time, in about 5 to 7 years, versus 30 years, versus 5 years, versus all these years? Would you be interested in that? Let's share with you what we do, all right? Instead of segregating the income from your hard-earned paycheck for the credit card or for the line of credit, let's go ahead and do this. Let's pay our income to the line of credit, okay? So we're going to do this instead. What does that do? Well, first of all, it gives us more cash flow. So we're going to go ahead and add that to the zero. Hey, isn't that awesome? And, right, plus, because we aren't suckers anymore, we know what they're doing with our savings, and that is making money off of us, right, by putting it in the lending pool. Let's go ahead and make sure that we do this number here. What that does is we're still in control, okay, of that $1,400. You'll see what I'm saying in just a little bit. So now we have $2,000 that is going towards paying off our debts. Watch this. So we see that the $12,000 at the 21%, $600 a month. No, not anymore, because we're paying it with our income now. But how long is that going to be? I mean, why would we do that? I mean, we have all these debts, right? Well, watch this. As you are paying your line of credit with your income, right? Remember, your expenses is $3,000 now. What's left? $2,000, right? So we place the $2,000 right here. Okay, while the $12,000 is on top. Remember how to notify yourself actually on how to get out of this? Okay, 12,000 divided by 2,000 is 6. So this is how long you're going to be in that line of credit. Not the 4 years, not the 5 years, not the 7 years, okay? 6 months. Why? Because you chose to allocate your finances another more effective and efficient way, all right? Now, the battle isn't over, okay? Because now we're going to make sure that we're using our line of credit to our advantage versus our disadvantage. So we take that 12,000 now that it's replenished after the 12 months, and what do we do with it? Now, you may be asking yourself, but CJ, I have all of these other things that I need to take care of. I know. Guess how they're going to get taken care of? The line of credit. Because can you pay the mortgage? Can you pay the car? Can you pay all of these things with the line of credit? Yes, you can. All right? Yes, you can. So now that we've replenished it at the 12,000, we replenished that 12,000 up, right? Now we're coming over here and we're saying, well, wait a minute. Which loan do I pay off first? Because you're getting a little bolder now, all right? You know a little more. And now you're looking, well, this I know is a cash flow sucking loan. So this is what we're going to do. We're going to deploy the $12,000 instead of consuming it. We're going to have it work for us. So we're going to deploy the $12,000 towards the what? The principal. That's right. Okay. So we're going to deploy that towards the principal, which is $30,000. We're going to knock that down to $18,000 now. Okay. Now remember how to pay off that line of credit now. That's right. With your check, right? With your income. All right. Now, it's $18,000 at 7.4%. While this is going on, you're still paying the $600 each and every month. Why is that? Because the loan is one way, that's a way from you, and the line, well, that's open-ended, right? So you can pay, borrow, just like we're doing, all right? So as you look over here, yes, you're going to continue, right, to pay that $600 each and every month, right? You went ahead and paid the principal down. What does that do? That places more, when you're placing that $600 a month, it's going to go to more of the principal than it is to the interest. Because remember how this payment is split up. Okay? $400 on this side, $200 on that side, right? What we want to do is make sure, and let's just say this was going towards the interest, this was going towards the principal. I'm being nice, right? Let's just say, okay, well, we want a little bit more to go to the principal because we want to get out of this as soon as possible. This is how you do it, the chunking principle, all right? So as we look here, we're saying, well, I mean, we're going to get out of that because it's only going to take us 6 months to pay back the line of credit. Then we're going to go ahead and hammer it out again. We're going to get out of that in a year and a half, let's just say 2 years. So in 2 years, not 5, okay, you're done with this, okay? You no longer need to be concerned about that anymore. Now, there are some that are like, you know what, CJ, I don't mind paying double what I paid for my house at the end of the 30 years. I want to pay out my nose, and I don't want this $1,200 a month to work for me. So I'm cool with continuing to pay. That's cool, right? No judgment here, not being critical at all. But if you did want to go ahead and get rid of that mortgage, I'm going to show you how that's done. I just want to go ahead and clean this up here for you. All right, let's take it back, right? Let's take our time back. Let's take our money back. Let's take our mind back. All right, let's take it all back. 200,000 at 6%. We're going to get rid of that by using our lines of credit wisely, okay? Now, regardless of if you have a HELOC or a First-Lien HELOC, which is definitely recommended, or even a bank personal line of credit, you can use lines of credit like this in order to get out and capture, right, this cash flow so that you can do something with it, all right? Let's do it. Instead of the 12,000, let's do this. Let's hammer away at it by deploying 13,000, okay? So we've already replenished the 12,000 back. Now we got a full $15,000. This is what we're going to do with it. We're going to deploy $13,000 of that towards our principal. There you go, the principal of this home loan. What that's going to do is it's going to be a smaller amount that principal eats, right? Because remember, the power of the banks is the interest that they are earning. The less interest they earn, the bigger the principal, right? And the more you can pay down your loan, okay? And that's what we want. That's why you're going to be out of this very quickly. Let me just show you, okay? Now, in contrast, 4 years, okay? Now, remember, you just deployed the $13,000. Let me show you what you did with that deployment. You just skipped ahead 4 years in your mortgage. According to the amortization table, you're actually going to approximately, right, if you kept on paying it, the $1,200 each month, that minimum monthly payment each and every month that you have to pay, it would dole out $13,000 in principal payments, but you would have given the bank $44,000 in interest in the 4 years if you kept on with that $1,200 a month payment. No strategy, just paying what they told you to pay. Let's not do that anymore, okay? Let's do it by strategic principal payments so that we are owing only $32,000 or $33,000 in interest, and we are out of this home in 5.5 months. How is that possible? I'm glad you asked. Let's go ahead and graph it out, right? You've got the line of credit here, say 10K is here, and then 0K is down here. You're in months here, 4, 5, and then 6, right? Remember, we deployed from the line of credit 13,000, right? The first month. That means what? You've got now a balance of 13,000 over here on your line of credit. But remember, how long are you going to be in that balance? 6.5 months, right? Because your cash flow, right? Matter of fact, it's going to be less than that because remember we erased your car loan. So now your cash flow went up. Do you want to go ahead and add that? Let's add that down here, okay? $2,600 now to your cash flow. So now that $13,000 is going to be divided by the $2,600, and that's going to be in less than 6 months. That's for sure. Okay, less than 6 months. So when we do that, we do still have expenses. But when we get paid, what does the balance do? Because now we're placing that $5,000 back into our line. The balance what? Goes down, right? So 13 minus 5,000, 13,000 minus 5,000 is what? 8,000. So now we're down here, okay, as we move along in time. Now, of course, we have those expenses. So those expenses are going to drive it back up to what? 11,000. That's right, okay? But When we get paid again, what happens? Down to, that's right, 6,000. Do you see a pattern here? Do you see a pattern? How that we go down, we go up because of the expenses, then we go down, then up because of the expenses, go down, up, down. In way less time than if we would have continued to pay the $1,200 each month. That's how we're able to capture all that interest instead of paying double for the house, because at the end of the 30 years, can you stomach it, right? You'll be paying like about $400,000 if you just pay the minimum monthly payment, right? That's the punishment on every loan, by the way, is paying the minimum monthly payment. You know why they suggest that you pay the minimum monthly payment? Why they write it down? Because they make money off the interest. They had to be forced to tell people when they're going to get out of the line of credit balance or the loan balance. They were forced to do that. That should tell you something, okay? Their power is in your ignorance, but you're not ignorant anymore. Look at this. The numbers speak for itself. Will you have expenses? Yes. Will you have interest? Yes. But will you have as much interest if you would have done it another way, right? A way that doesn't work? A way that you were brought up in? Is it better or is it not? Now you do the calculations, right? $33,000 in interest is how much you'll pay on this house. How much will you pay if you continue to do it their way? Now, you're done in 5.5 years, okay? You're done in 5.5 years, and there are no more loans. And so the question then becomes, well, what else am I going to do with this money? And I'm glad you asked, because this is what you do. So here we are. No more debts. No more segregating income. We've got hundreds, thousands actually, in cash flow, and we don't have any more debts. That $1,200 gets added to the $2,600, and now we have $3,800 a month coming in cash flow. Now, if anybody has ever read or listened to Robert Kiyosaki's book, Rich Dad, Poor Dad, or even the cash flow quadrant, you would know that once your cash flow is above your income or above your expenses, you can actually go ahead and quit your job, right? Especially if it's going to be above your income. It then becomes too expensive to go to work. And that's where we want you, all right? Now you got a house that's fully paid for, 5.5 years, not 30, not 40. You're out of that debt pledge. That's no longer you. So now we want you to step into the world of real estate investing. All right? Now, with the first lien HELOC that you'll get on this house, all right, let's just say you have access to $160,000, right? Is that enough to go out and put a down payment on a subject to? Is where we take over the existing mortgage without assuming the loan, right? Otherwise, it'd be a loan assumption. That's not what we do, okay? We're going to go ahead and take it over, all right? We're going to say, hey, man, we're going to go ahead and pay those payments, right? Whatever the payment is. But say, whatever the payment is, we have, right? Now we've taken over that mortgage. We have a rental now that we can cash flow $400 on. Now, you know, not going to get into the specifics of how we get tenants in. If you want to know about that, we definitely can. But tenant screening is a must. We've got to make sure that we get good tenants in there. But let's just say whatever the amount is, each and every month, we make sure that we're cash flowing $400 each and every month. Now, with doing things the velocity banking way, we're going to be out of this mortgage quicker than you know what to do with, okay? So let's just say the mortgage was $100,000, right? So how fast, if we got rid of a $200,000 mortgage, how fast are we going to get rid of a $100,000 mortgage? Okay, well, let's just say we get rid of it in 4 years. You want to, right? So out of this in 4 years, especially with the cash flow that we have, right? Now, this property is cash flowing $400. Can we get another property that does the same thing? Let's just say that's about 400, right? And we've got enough, because let's say we get another HELOC on this, right? And they give us, let's say, $80,000. Can we get 4 properties with $80,000 at $20,000 a piece? Yes. So that's 4? Okay. I was about to draw another one. You see how this house has kids now? Now, remember where, and say each of these will cash flow the 400. Where does this 400 go? The cash flow. 1, 2, 3, 4, 5. That's $2,000. Now, you're cash flowing more than you're making. Okay? That's $5,800 from the rental in 4 years. Okay? So now that you're cash flowing $5,800, how fast are you going to be out of these rentals? Because remember, when you're done, right? When you're done with the paying off the mortgage, those renters that are the tenants that are still in, right? They're still paying. So let's just say they were paying what, $1,700, right? Is the average $1,600, $1,700 each month? So now the $400, okay, on this house that's paid for is now $1,700. Do you see what I'm saying? And so I just want you to make sure that you know, first of all, what a subject to is, next, how to get it, right? And this is very important, especially with the times that we're in right now. It's time to come from the middle class to the wealthy class. This is one way that you can do it. If you got any questions, go ahead and get with me. Please like, share, and subscribe so that everyone around the world can know the power of Velocity Banking. God bless you. That's how you'll go from debt to wealth. And we'll see you in another video.